Aavas Financiers, a mid-cap affordable housing finance company, was one of the best performing stocks, rising 131% in the year 2019. Undoubtedly, this was on the back of its business, which was growing from strength to strength and was reflected in strong earnings growth in FY20 as well. In our Ideas for Profit today, we'll discuss if this company should be on investors' radar. Well, a Moneycontrol research team had also spotted this stock around the peak of liquidity crisis back in 2018, suggesting that Aavas will not only survive but will also flourish in that kind of a liquidity crisis. Now, we continue to maintain this stance and also believe that it will once again successfully navigate through the challenges that are currently there. While its business in the current year has definitely been impacted by the nationwide lockdown, we do see Aavas's business normalizing to pre-COVID levels much faster compared to the other non-bank finance lenders or NBFCs. But what makes us think so? Well, the pandemic has added to the woes of NBFCs, which were already reeling under pressure in the pre-COVID times already. Now, assets under management, or the AUM of NBFCs, is also expected to degrow for the very first time in nearly 2 decades in FY21. The pandemic and the subsequent lockdowns also are set to increase the asset quality challenges of NBFCs going forward from here. But the collection efficiency is trending better for housing finance companies currently. That gives us confidence. Within the housing segment, also the niche segments such as affordable housing segments, mainly the loan ticket size of up to say 15 lakh rupees, will continue to grow at a much faster pace given the current low penetration levels and also the government's thrust on the affordable housing segment as well. Now, as per Goldman Sachs, the total loan book of the players in the affordable housing segment is around say 1.5 trillion rupees currently, and that could potentially increase to about say 7.5 trillion or $100 billion in the next 15 years, implying a growth rate of around 15% on a compounded rate annually. Also, while banks are also present in the smaller ticket home loan market, their lending to the economically weaker sections, the EWS and the low income group without any formal income proofs, is quite limited to that effect. Now, this presents an exciting opportunity for a pure play affordable housing finance player like Aavas Financiers. Now, Aavas's 7,935 crore rupees loan portfolio at the end of June 2020 grew by 25% year on year. And that's despite the disbursements collapsing by 68%. We saw the loan portfolio growth was quite healthy as rundown in home loans is lower because of the longer tenure. Now, the encouragement part is that the growth of around say 47% CAGR in its loan portfolio in the last 4 years has also been volume driven. Now, Aavas's average ticket size stood at 8.3 lakh rupees as at the end of June 2020. Aavas's loan book is still very small portion, less than 3% of the overall pie. Hence, conservatively, its loan book can actually continue to grow at more than 25% per annum in the medium term. Now, Aavas's liquidity profile is quite strong. It has a cash and liquid investments of about say 1,500 crore rupees, which is equivalent to about 26% of the borrowings as at the end of June 2020. Now, thanks to the diversified funding profile that it has, it didn't face any liquidity constraints also. Now, the company has demonstrated a significant improvement in its cost structure as well. Though margin compressed in Q1, we also have to see that it was partially offset by the improvement in the operating efficiency with an increase in the scale of operations as well. Now, asset quality is reasonably good considering currently Aavas has built a relatively low risk loan book with a gross NP of 0.5% at the end of June 2020. Its portfolio under moratorium is 17.8% in June, one of the lowest in the housing finance industry as well. So that is a positive. Now, the ongoing challenging operating environment amidst the COVID-19 pandemic can definitely lead to some weakening of the asset quality and also the profitability, so that we are keeping in account. However, Aavas has sufficient capital buffer with tier 1 capital adequacy at say 54% at the end of June to absorb any kind of asset side shocks. At the current level, Aavas is trading at 4.4 times FY22 estimated book value, which appears quite full at the moment, though the stock has also risen about 50% from its lows that were seen in May of 2020. It still is trading lower when you compare it with the peak valuations seen in the pre-COVID times. Now, considering Aavas's growth potential, we do believe that premium valuations will sustain going forward as well. So, long-term investors can actually look out for any kind of a price correction opportunity to buy into the stock.